From the morning reading, spiders, diamonds, and Qs open higher and grind sideways in a range-bound trading market. IWM moves lower. Oil rises for the third straight day. 5 of 9 sectors moved higher on Tuesday. XLE, XLK, and XLF were the strongest sectors, while XLV was the weakest sector. Oil futures rose 36 cents to close at $50.20. Breadth strengthened as advancers led 1687 to 1306 on the New York Stock Exchange and 1492 to 1035 on the Nasdaq. In the S&P snapshot, there was a modest gain on little news. Global markets were mostly positive again, but at more modest levels. The Nikkei rose 1.28%, but that was over 1% lower than yesterday's gain. The Euro Stoxx 50 gained 0.83%, well off the 3.29% surge from the day before, in a general sense of reduced Brexit odds. Our benchmark S&P 500 traded in a narrow intraday 0.51% intraday range, which is in the 9th percentile of the 118 market days so far in 2016, ending with a modest 0.27% gain. Chair Yellen's congressional testimony had little, if any, impact on today's action, since it varied little from the tone of her post-FOMC meeting press conference of last Wednesday. The 10-year note closed 1.71%, up 4 basis points from the previous session. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:37 a.m. Central Time, and I'm recording this in preparation for the market day of June the 22nd, 2016. Full disclaimers at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. This is the first day back after being gone for several days. I was taking a master naturalist course in Glacier National Park and didn't have great internet connection, so wasn't doing the regular morning market preview videos, but back in the saddle now in my regular trading desk and normal internet connection. So let's get going with this. In terms of the 4 U.S. broad-based indices, we're all up, though the S&P and the Dow are up just above scratch at the time of this cut. Russell futures are up about 1/3%. NASDAQ up just barely above scratch. Crude oil's up less than 0.25%. Euros up about 0.25%. Bonds are down less than 0.25%, and gold is just below scratch. In overseas action, you have China up nearly 1%, Hong Kong up about 2/3%, Japan down about 2/3%, Germany up about 1%, United Kingdom up about 2/3%. And macroeconomic reports for today, with respect to the United States of significance, you have Fed Chair Yellen continuing to testify, and you have existing home sales and the weekly version of crude oil inventories. Looking forward towards tomorrow, you have the weekly unemployment claims, new home sales, nat gas storage, and then, of course, we'll be setting up for the Brexit vote coming out of Great Britain. In terms of current volatility conditions, we have been on a short-term VIX at a 22.47, so still quite elevated, and this volatility is probably going to remain until after the Brexit vote. Indeed, if you look at the 10-day out expected move on the SPX, it's well up over 60, as well as there's been a number of announcements from various brokerage houses of increasing of margin requirements as a result of the anticipated potential volatility coming out of the Brexit vote. So be aware of all that, especially if you carry futures positions into the overnight. You see the skew up over 135, so that certainly is in a warning status, and that would reflect about I guess that was about 13% probability of a 2 standard deviation move in the next 30 days. IV percentile, these are still all relatively low. They're still all below a 26. Yet at the same time, these are clearly up from where they were a couple of weeks ago. The S&P's at a 26, the Russell 21, NASDAQ 23, and Dow at a 23. No standard deviation moves were put in on a close-to-close basis yesterday. You notice there's really been very little in the last week worth of trading sessions. The last 5 trading sessions have only seen one event on one of the 4 indexes. In terms of the current charts, let's go ahead and bounce over there. And you note, this former area of significant resistance is still in play, though we had this retracement and then bounce off the sweet zone, though we had some undercuts. We've talked about this area between the 50 and the 618 fib, and you notice while we did have some undercuts, none of the closes really were below that 6181 right at it, and then that then found support and then started to move back up, and we're starting to see some signals now for another short-term up move. Wouldn't make too much of this yet. We've actually changed, and we'll get to the daily report in just a moment, but with the break of this this pattern here and a close up above that pattern, we've now moved back into a market phase 2, which is a trend reversal. We also have a number of other improving technical markers, but this is all in front of the Brixet vote. Will likely go relatively sideways for the next couple sessions as we anticipate movement into the Brixet vote, and then coming out of the Brixet vote, it could explode either direction. We have no idea which way this could go. So you got to keep in mind that while these patterns might be saying, okay, we've had a trend reversal, now we're expecting the short-term pattern to be bullish. Well, the Brixet vote's going to probably trump all of that, and it'll go up if the Brixet vote comes out favorable to what the markets think it should be, and probably the anticipation is that if they vote it down, vote to stay, then the markets would be positive. If they vote to leave, then the markets would probably take that as a negative. Now, that being said, there's winners and losers within. For example, if you own Johnson & Johnson, well, you might fare differently than if you owned something that wasn't as impacted by the British pound. So a couple things you got to keep in mind, and there'll be a lot of wiggling back and forth, and certainly there's an opportunity for a volatility event in the very near term future. In terms of the Dow, this has been marching in lockstep lately, nothing really to separate. The Russell, of course, has been relatively weaker, but certainly hasn't, had a real reversal signal yet off of these bottoms, though, is setting up for a potential. I don't think it'll actually signal anything until after the Brixet vote at this time. And again, we continue to minimize, even if we get a signal, it probably could get trumped. So one of the things that you have with the NASDAQ, both remember the Russell and now the NASDAQ, in relatively weak positions, and these are your growth oriented. Nobody's really wanting to get out in front with these higher beta stocks with big positions and be accumulating a lot of stuff just in front of the Brixet vote. So as you would expect, the more defensive sectors such as the Dow and the S&P 500 are holding up relatively better than the Russell and the NASDAQ going into that vote. In terms of the current bonds have been coming down from their new 52-week high, which was set several sessions ago now. But again, very much tied to the Brixet vote, probably going to be impacted. Gold will do the same thing, and gold has been coming down just like bonds of late as the some polls were pointing to remaining, and the market's kind of taking those hints and kind of moved up in anticipation of that outcome, and yet at the same time the polls are so close. Not sure that anybody with significant institutional money is making a big bet in front of that event. In terms of, let's take a look at volatility. You see how volatility has spiked? Though it's come down the last few sessions some, it's still very much elevated from where we've been in recent weeks. And there's nothing else other than the Brexit vote really to justify that spike and that continued elevated volatility. And here's the regular VIX. Very much the same pattern as the VIX futures, of course. And let's take a look at crude oil, and we'll finish up with the charts. Had an undercut of the channel, but very quick reversal off of that undercut. So one day down, close, and then the very next session, big bullish candle back into the channel. And it would seem that crude oil will continue to hold its channel support, and will likely try to move up towards the $56 mark at some point in the short to intermediate term. Okay, that's probably enough with the charts right now. Let's go ahead and go to the daily report. And we've had a number of changes since we were last together. We've now got intermediate term phase opinion phase 2, a trend reversal. Again, be careful not to make too much of that. All these status, mechanical signals, etc. could be trumped by that Brexit vote. We do have some warnings in place, and they continue. The first of 3 mechanical signals coming to us from IBD with an uptrend under pressure, though a big positive with volume move after the Brexit vote could probably take this back up to confirmed uptrend. So some of these signals have been starting to improve, but we still have this mixed bag of positive signals and warning signals. And on the warning side, the GMI index has deteriorated to a 3 out of 6, and the more sensitive GMI 2 is a 4 out of 8. So it's on a buy signal. It's been that buy signal since 525, but it certainly has been a relatively tenuous buy signal. The stock charts decision point scoreboard also a rather decidedly tenuous buy signal on the intermediate term, because the short term in all 4 of these is neutral to bearish, and that's against a backdrop of the long term also being mixed. So a very, very, very poor stack at this current time, and probably pretty accurate reflection of where the market is going into the Brexit vote. Really no ideal whether it's going to go long or short coming out of that announcement. Current position sizing opinion models, these are both mechanical. One's at 50%, the other one, the volatility base, is at 50% as well. In terms of intermediate term market posture, we're on the second day of a strong bull signal. This is against a backdrop of a weak bear sentiment line. So most of the time, I don't particularly like signals coming in from this area with the first or second day bull signal, and often I see these subjected to very quick rejections and reversals and turn back over to weak bear signals. We'll see where this goes. Ultimately, I believe that the Brexit once again will probably give us our real signal. So don't make too much either side of this current intermediate term market posture and strong bull signal that's come in this 2 sessions ago. Hedge warning status remains level 1, a caution light. We certainly have plenty of evidence of reasons to remain with an elevated risk level in our assessment. In terms of specifically the market in decline, sharp increase warning, we still have that VIX spike present, waiting for a re-entry signal from that. And the VIX futures are still up over 18. Distribution day count on the S&P remains at a 5. So in the warning status, our skew is elevated. And our 10-day expected move also up over 60. So well above the warning status there. In terms of the key intermarket risk aversion indicators, notice that while all 5 are still mechanically in the risk off they've been rolling up, and several are very close to crossing over and going on to a risk-on posture. So this often is one of the more sensitive indicators to give us a sense that things are starting to turn in the overall risk-on, risk-off wars. And certainly, I have to note, while mechanically the signals have not changed, there's significant improvement being shown there. We are in our special opinions, option income strategies, VIX not acceptable to initiate new positions, and frankly, in front of a Brexit vote, which dramatically take the market in either direction, that is not an environment for novice traders to initiate new positions. In terms of cover call strategies and put selling, I probably would also call that very borderline acceptable to initiate new positions for novice traders. Probably best to wait until the other side of that decision, develop your watch list, be ready to take action, and then move once you get that decision. You give up the opportunity, if the market were indeed to move up, to be able to capture that. And yet at the same time, the market could move down with such action as to make, the returns that are expected from cover call strategies, very, very much in question. If you want to get out in front of something, consider put selling, and especially with a reduced position size and a scale you are willing to own. That is probably the most sensible way to take a position in front of something like a Brexit vote. In terms of sentiment indicators, stocks, both short and medium term, are both very, very neutral. In fact, if we go down to CNN Money's Fear and Greed Market Sentiment Index, it's still in the greed category right now, but not far above the regular neutral zone. So this is certainly not extreme by any measure at this point. Now, in terms of specific ETFs, gold is in an extreme sentiment position. So what you've got to do is watch for those reversal patterns. Just because it's extreme doesn't mean it's ready to turn. In terms of sector specific, you see mostly green, though transportation, retail, and to various degrees healthcare and financials. Indeed, if the Brexit vote comes down as a vote to exit the euro, the financials would likely take a big hit, especially those international banks. They would likely take a hit that would seem to be a loss for them, and they would probably take a pretty severe hit. So kind of keep that in mind with the financial sector, especially if you're going with big bank kind of stocks. In terms of percent change for yesterday, you see energy was the leader, followed by telecom. Financials actually had a respectable day, but it's quite a mix really with the high beta, low beta, defensive versus non-defensive. It was kind of all over the place yesterday, with nobody really getting big time out in front except for maybe energy, and nobody really having a terrible day, with materials being only down 0.3% as the worst sector. So that should be enough. I don't guess we've shared this week's relative rotation graph. I'll go ahead and show that. Again, note that FDN, that's your internet. Here we go, the Internet Index Fund. That's the one that's been improving. Also, this KRE, that is your regional banks. Remember, they won't be affected the same way the big international banks will likely be affected. So, though all financials could get taken down together if the financials take a hit with a Brexit vote going against. So kind of keep that in mind. But most of these, have been tailing off and falling down, coming out of the strong zone and going into a lagging or weakening position. So this is not a great sign, but ultimately the whole market is probably, you can almost draw these in circles. They're just kind of going sideways and flip-flopping back and forth in their relative rotations as the market is trying to anticipate to various degrees the Brexit vote and where to go, where to position capital in front of that. Really not a lot of definition to that. So let's go ahead and go and wrap this up. We're closing in right at 20 minutes. I'm going to scroll through these in the sequence here. If you see something of interest, just hit the pause button and go ahead and get your additional details. In the meantime, we'll go to the disclaimers. If you have the need for more time to review the disclaimers, hit the pause button. Also note the hyperlink down here at the bottom to take you to the full set of disclosures. And we'll be back here for the next session with the market preview from Falcon Global. In the meantime, good trading. Keep that risk in control, especially in front of a high volatility event such as the Brexit vote.